Good morning, everybody. Thank you for tuning into this week's Spiders preview. We're going to look at the different sectors that make up the S&P 500, see if we can make some or gain some insights into which way the market's going to move over the next week or two. So, as we know, last September we really talked about the top right when it was happening because it was pretty obvious at the time. Trend line breaks, support breaks. And then a few weeks ago, when the market got to the bottom, when the S&P was around 2,600, we kind of thought it would be a bottom because the market was oversold and was at significant support. So last week I said I was neutral because I was neutral. I just didn't see anything going on one way or another. And I pointed out that in the SPYs, there's probably going to be resistance around 2,800 or 280, because these are 1/10 of the S&P. And there's going to be support around 270. So that's kind of what played out. So now the SPYs are at the top of that range. They're at 280. I'm not sure what Friday's close was. Excuse me. But they're slightly overbought. So I think we're going to see some selling, and I think we're going to get right back into the range for this week. So I'm still on the sidelines. I'm still neutral. But I do have a few reasons to why I think the market's going to kind of sell off as opposed to break through the upside. And we'll go through those in a minute. The first is that I think the financials are setting up for a break of a support, and also there's some interesting action in the staples where people that are bearish put money in staples because you always need a staples, right? Like you need water, you need food, whereas discretionary is video games and I guess, I don't know, Ferraris, things like that. But you get my point. So when people are bearish, sometimes money flows into staples. So I'm seeing bullish action in staples, and I'm seeing bearish action in the financials, or potentially bearish action in the financials. But we'll get to that in a minute. All right, so just to review what we do here and what my philosophy is, or my method is, just remember that there are certain price levels that are more important than others when it comes to the amount of, or with regards to the amount of supply and demand that exists at them. Wait, sorry. I don't know why I keep coughing. So anyway, there are levels that are more important than others, and then financial markets prices are always doing one of three things. They're either going up, going down, or staying the same, right? So if you can recognize these trends, which is what prices are doing, and if you can recognize these levels, which are levels that are important, you could help your trading strategy, or you can even do what I did and just build a whole trading strategy off of it. So as a quote unquote technical analyst, I just, I have to bring up like GAN theory and harmonic charts and Elliott wave and what else? I don't know, Fibonacci. I mean, to me, that stuff is not legitimate. I mean, it's fun to talk about. It's like UFOs and Bigfoot. But I can honestly tell you that in my 20 years as an institutional trader, I never once ever heard a successful hedge fund manager talk about GAN theory or harmonic charts or Fibonacci or Elliott wave. All right, I mean, it's fun to talk about. Maybe some people can make money off of it, and great for them. It's just not what I do. It's just not how I'm wired. I think that technicals should illustrate supply and demand dynamics that are going on in the markets. And when I look at a harmonic thing like a crab or a butterfly, I'm thinking more about like kung fu, like, oh yeah, I got crab style, or my butterfly style is more powerful than your, whatever crab style. So anyway, that's not what we do here. And again, we're not looking to give recommendations unless we see one. I just want to point out where these important levels are. Because when you're a hedge fund trader and you go into work every day and you have big blocks of stock to move, either buying or selling, you got to learn how to do it without spooking the market. So if you get 1 million shares to sell of a stock and there's 50,000 shares on the tape, you need to know where will the buyers come out? Where can you sell this? And you're not going to be looking at a harmonic chart or a GAN theory. You're going to be looking at where is support? Where was the last time the buyers came out here? Where are the sellers? All right, so that being said, sorry, I don't know, it just gets me upset because I just feel like the people that some of these proponents that do this stuff are ripping people off, and I don't know. It's like Long Island Medium. My wife watches that show because she's from Long Island, and it's like, I don't know. Can she really speak to the dead? Does she really believe it, or does she know that she's just ripping people off and making money? So I don't know. I guess that's a conversation for a different time. But I know that guy John Edwards was a big, thief, and well, whatever. I have a tragic situation in my family where someone I know went to see him, and I don't know. Guys are scam artists. Hopefully he's gone. But anyway, all right. Let's move on to more positive things like how we're going to make money in the markets. All right. So here's just an overview. We'll go past this. All right. So here's the SPY since May, and you can see that this is what I talked about, right? We talked about how there's going to be probably going to be resistance at this 280 level. And why did we say that? We didn't just pull a number out of a hat. We didn't look at a harmonic chart. 280 was important here, and it was also important earlier in the year, and we're going to look at that on the next chart. But anyway, so it was pretty much a clear top here with support here. Then you can see when this market sold off, there's where we found support. There's resistance here. All right, so that's why I think the 280 level is important. So I said we're probably going to run into resistance here, which we did. My guess is we come back and then we spend the next week or so like in here in between 270 and 280. So I'm still going to stay on the sidelines. The reason why I think it's going to come back in is just because we're overbought. And this is kind of a reversal pattern here. Actually, it's not kind of, it's a totally reversal pattern. You see up. On this day, the forces of demand were in charge. On this day, the forces of supply and demand equalized. And on this day, the forces of supply overcame the forces of demand. So anyway, pretty much going to be neutral until one of these levels is decisively broken. Now this is a longer term. This is this SPY's here today, and you can see, all right, this is why the 280 level is important. Back here it was important. Back here it was important. And then again, we just talked about this. All right, so you don't need to be a chart guru or some Wall Street expert to see that 280 level is important. All right. The 270 level is important because this is where the lows were in May and June. Yeah, now I know it broke down through here, but sell-offs are more volatile than buy or tops. So we got oversold and we found support right around 260. And this is what I talked about a few weeks ago. The reason why I thought, or why I knew, well, I shouldn't say I knew. The reason why I was very confident that this was the bottom was because oversold and at an important support level. All right, this was oversold, found support around 260. Oversold, found support around 60. Oversold, found support around 260. So longer term, I'm watching this, all right? I don't know if we have a longer term bear market happening or it's going to happen, but I'm on the sidelines longer term until this level is crossed. I'm on the sidelines intermediate term or shorter term until this 270 level, holds. But like I said, again, I think the market's going to hang between 270, 280. I'm on the sidelines until one of these levels is decisively broken in one way or the other. Here's the tech sector. And the tech sector is hard to follow. That's why I don't trade it, because it's just too volatile. But we talked about the 71 level. We thought we'd find resistance there, which we did. And that's because at this point here, it was an all-time high. So you can see there's a little bottom there. So anyway, I was looking for resistance around 71. I mean, I'm going to continue to look for support down here around the 68, 60 level. But again, these things are volatile and bottoms are much harder to find than tops. But if you trade them, that's what I'm seeing there. All right, so 68.60, 71. All right, so now this is one of the things I mentioned, that this is why I think we're setting up for at the very least a short-term sell, sell off and get back into that range. Because the S&Ps, or I'm sorry, the XLFs, this is the financial spider, they're above this 27 level, all right? You can see 27 was important in February, or actually March, April, May, June. Okay, I know that we sold off here and we broke through it, but whatever. Sometimes markets still come back to where they used to be, especially because bottoms are more volatile. So once a bottom goes through and things get back to normal, those levels might come back into play. So anyway, I'm watching this 27 level. My suspicion it's going to break. I'm going to be looking for support again at this 2640 level, and that would probably coincide with the SPYs being at 270. So that's one of the reasons why I think we're not going to break through to the upside, at least over the next few days or at least week. And keep in mind too, tomorrow is Veterans Day, so it's probably going to be lower volume than usual. So any move might be exacerbated. Is that even a word? Any move might be exaggerated just because there's a lack of volume. And again, this is the XLFs. And this is one of the reasons why we were confident that we saw a bottom a few weeks ago, or last week, or whenever it was, because we got down to this important 25 level, right? Oversold that support. You can tell 25 was support because it was resistance here. So that's why we thought there would be support there. So again, longer term, if this 25 level breaks, that could show that the market's going into a bear market or a big sell. And don't be shocked if we go into a big sell-off. And I don't mean like a crash or anything. It's just, over the last, people are so shocked that the market's gone down over the last couple of months. So when I tell people that ask me, especially people that aren't in the stock market, it's like, markets don't just go up. They go down sometimes too. I mean, you wouldn't have a market if it just went up, right? So this is normal, healthy action, okay? I mean, I know it sucks losing money if you look at your statement or your 401k statement, but if you're a trader, you just got to deal with this stuff and know when to hedge and when to go short and so forth and so on. But like I said, it's just normal, healthy action. And again, look at this. This kind of isn't going to be in play for a while, but I just like to point this out because it shows how levels really are important. And I would ask you to ask your academic friends or your efficient market friends, people that actually believe in that garbage, how can the XLFs has the same valuation here as they did here? 11 years later. I mean, oil prices are different, they have a different president, interest rates are different, the economy is different, but yet somehow these levels came into play. And I mean, this is really extraordinary if you think about it. Mass psychology, you know how many millions and millions of people around the world are trading these things, yet somehow it finds a level at the same place. It really has to do with how humans are ant colonies or herd behavior or things like that. Like in an ant colony, all ants do is move based on what the ant next to them does. They don't understand that the whole colony is moving down the river or whatever. So within their little realm, they're moving, but that creates or that adds to the whole aggregate thing. All right, I know I'll get a little weird on this stuff, but I think it's very cool. I mean, these charts are not charts. I mean, they are charts, obviously, but it's really a study in mass psychology. I mean, look at this, right? I always like to point this out to efficient market people. Why do markets go down faster than they go up? Well, because markets go down on fear, and fear is panic. Markets go up on hope, right? Hope is a much weaker emotion than fear. So if markets were truly efficient, they would go down at the same speed they went up. I mean, gosh, I could go to Harvard and get a doctoral dissertation of that, but whatever. I don't want to. Oh, I got a joke. You know how you know someone went to Harvard? It's because they tell you within the first 2 minutes of meeting them. All right, sorry, Harvard. All right, so now we're going to see some choppy stuff here, which is another reason why I think we're going to go down a little bit. The XLVs are back above this 92 level. This level was important because it was a top here and it was support here. But I think this level is kind of diminished in importance. So I would suspect the XLVs are going to get back down here. But I'm still going to watch this 92 for the top. I'm still going to watch this 85.50 for the low. This is where the recent lows were. This is where support was throughout July. This is where the top was in February and March. So that 85.50 level is an important level. And again, it's like I said, certain levels are more important than others. This is a perfect example. 85.50 is clearly more important than, I don't know, let's call this 88.50. I mean, no tops or bottoms were at this level, whereas here you have a top, here you have a top, here you have a bottom, here you have a bottom. This consumer discretionary is kind of setting up the same way, testing this 110. But again, I think this will probably break because this is a reversal pattern. See here, on this day, which I guess was Wednesday, the market opened here, buyers took it up here, and that's where it closed. Thursday, market was flat. Friday, the sellers took over, drove it back down. So I would suspect we're going to get back down into here. I'm going to be watching this 107 level for support. I'm going to be watching the 110 level for resistance. Okay, here's the industrials. We got back above the 71 level. You can see the 71 was important because it was support here, was support here, was support here. And again, you know, when you have these big sell-offs, bottoms never form perfectly. Tops are like, look at these tops, right? Look at how symmetrical that, or I don't know if symmetrical is the right word, how equal it is. I mean, this thing was like within 50 cents of 80. We get to right here, same thing, and that's where the market turned. But bottoms get more momentum and they get more fear. So let's just pretend that didn't happen. So I'm going to be looking at 71 for support. I'm going to be looking at the 76 level for resistance going forward. All right, now this is what I mentioned, how the XLPs are trading higher, right? I mean, we just saw how a lot of things are precarious or looking like they might go lower, but staples are just going higher. And this, I mean, there's a little bit overbought, but this is a place where smart money parks their money if they think the market is going to go down because, like I said, you always need water, you always need food. Those are staples. Discretionary things are like, you know, high-def televisions and things like that, PlayStation, or I have Xbox One actually. I just started playing the Red Dawn or Red Dead Redemption. I mean, it looks pretty cool. I just uploaded it and did all the downloads last night. I admit it. I know I'm 49 years old, but I like to play games on the weekends. So anyway, if this goes lower, here's your first level to watch. That's important. 53.50. Bottom here, support here, bottom here. Now let's take a look at a longer term picture, and this is much longer term, but again, just to show you how levels are true and they exist. This is the 50 level. You can see it was basically the top all throughout 2015. It was a significant low last September, so what was that, 13, 14 months ago? It was the top through May. So if we go lower, I would expect significant support there. If it breaks, I would be looking for a big down move. Okay, here's energy. And we talked about how energy had support around 66.50. We found a bottom there. And the reason why I think that is because of what was going on back here. Right, February through May, that was the bottom. So I'm going to be looking at 66.50 for support. I'm going to be looking at 72 for resistance because it was the bottom in August and September. And again, this isn't rocket science. You just have to look for which levels are important, which levels aren't. I mean, for some reason, no one cares about the 70 level. Well, I guess short term they do. Sorry. But you get what I mean. Like back here, no one cared about the 70 level. but they cared about the 6650 level. And this chart really shows it. It's a clear illustration of how the 78 level is important resistance, right? Yeah, I mean, you don't need to be a chart guru to see this. Bam, bam, right? 78 is important resistance. So if this thing rallies to 78, and I would assume that it will, assuming our civilization doesn't collapse, at some point in the future, it's going to get back up to 78, and we're going to see some significant resistance there. And here's the bottom that we just talked about, the 6650 level. So, I mean, I know it's a longer term call for the upside, but I'm watching the 6650 level. I'm watching the 78 level. Okay, here's materials. And everyone knows I hate this sector because it's very boring and I can't make any money off of it. But anyway, I just want to point out the 5350 level was resistance back here, was support here throughout the end of 2017. So we're back above it. So I'm watching 5350 for support, and I'm watching 58 for resistance. 58 was the bottom from June throughout October. All right, and last but not least, we have utilities. Utilities broke the recent uptrend. I mean, we've been talking about this for like 3 weeks. This thing hasn't really done anything technically significant for 3 weeks. But anyway, if we head lower, look for support at 52. That's where the bottom was here. Bottom was here. Top was here. If that breaks, I'm looking for support down here around 49 because that's where the bottom was here. All right, everybody. Well, hopefully this could be helpful. Again, I'm thinking the SPYs are going to sell off a little bit, but then get range bound again. And you know, it's not set in stone, but me personally, I don't know what you're going to do. You do what you want to do. But me personally, I'm going to be on the sidelines until one of those levels breaks decisively either way. So I don't know what I'm going to do. I don't know. Maybe I'll go play some golf, take my dog for a hike in the woods. Golf is easy for me. Well, not that it's ever easy, but you know, I live in Connecticut and all the leaves are gone. So I could hit a slice that would have been into the trees a few months ago, but now it's going to end up on another fairway, but I'll still have a nice shot in. So, all right. Anyway, thanks everybody for tuning in. Hopefully this was helpful. You know where to reach me, and I will check in with you next week. Thank you.